Hello and welcome to Wall Street, where we elevate you. To start your journey of getting to financial independence, you need to master the basic money skills to improve your financial literacy. A lot of people believe that just because they can spend money, they know how to manage it, which is absolutely not true. Managing money is an art. The reason why successful companies like Amazon and Apple are very successful is that they have a team of incredible accountants who have been playing around with tax regulations to keep most of the profits they make to the companies so that they can keep investing in themselves to keep producing innovative products. And note that it is not just Apple and Amazon. Other individuals like Donald Trump have been avoiding taxes for years. Despite his whopping $3.5 billion fortune, Trump has only paid $750 in federal taxes in 2017, and he had completely avoided taxes in many prior years. We will not dive deep into accounting skills and the methods they use to avoid taxes because we are going to cover that in future videos very soon. Today in this video, we will shed some light on 5 very important money skills you must know. But before we get into that, make sure to give this video a thumbs up and subscribe to this channel if you haven't yet. This will help us grow so that we can make even more videos to share with you right here on the channel. Starting with number 1, asset versus liabilities. In the book Rich Dad Poor Dad, the most important idea the author is trying to get to his audience is the difference between assets and liabilities. The reason why so many people are struggling financially is that they don't understand the difference between assets and liabilities. An asset is anything that puts money into your pocket, whereas a liability is anything that takes money out of your pocket. The concept looks so simple, yet most people get it wrong. People buy houses and cars and think that they are acquiring assets, when in reality, they are not. When you buy a home, you have to pay taxes, utilities, insurance, and so on. It constantly takes money out of your pocket, which means it's a liability. Your car is also a liability. You have to buy fuel, pay insurance, maintenance, and so on. However, if you rent that car out and it brings more money than it takes, then it turns into an asset. The same applies to a house. If you rent the house out and after subtracting all the expenses and it ends up generating income, then it's an asset. The rich buy assets, the poor buy liabilities, and the middle class buys liabilities that they think are assets. Number 2, taxes. Taxes are one of the most complicated things out there, and that's not by accident. They are meant to be complicated so that your average folk wouldn't understand them. The tax code is written by the rich to keep them rich. While on paper, it seems like the tax rates on rich people are high, but in reality, rich people pay a small amount or, in some cases, close to nothing in taxes. Corporate taxes in the US were around 39% during Obama, but no one really paid that much. In fact, sometimes they paid nothing. When you pay taxes, you pay a fixed percentage based on your income. But when a company pays taxes, they first subtract its expenses and pay taxes only on its net income. And that means a company can have as many expenses as it wants. A rich person doesn't pay himself to live lavishly, but uses the company's funds to cover his expenses, and writes them off as business expenses and ends up paying lower taxes. Many rich people run their companies at a loss to keep paying for their lavish life and at the same time avoid taxes. In fact, you can forward your losses to future years, so even if you end up making a profit, you can deduct last year's losses and still avoid taxes. When politicians say that we will increase taxes on the rich, they don't mean the ultra-rich who make billions, but the middle class who makes over $500K. Since the $500,000 is taxed under income tax, which is the highest tax rate in almost any country. If you don't master taxes, even if you end up making millions, you will be paying a big portion of that to Uncle Sam. And that takes me to the next point. Number 3. It's not how much money you take that matters. It's how much money you keep. Let's say you are a successful lawyer in New York City, and you make about $1 million. You are going to take home only $532,382 of your total income because federal and state taxes are going 46.7% of the $1 million. You are literally giving half of your money to the government. And if you have a mortgage or a car loan and other expenses, you will hardly be making ends meet. Even with a $1 million income, you will be living paycheck to paycheck. That's why what matters at the end of the day is how much money you can keep after paying taxes and covering your expenses. If you lose that job, the government isn't going to give you back that $500,000 you paid in taxes. The bank is going to come after your house and the car. But even if you had some savings, saving alone isn't enough. That's why you need to know how much money you keep. Number 4. Learn how to let your money work for you. Having a lot of money sitting in your bank is useless to a certain degree because money is a resource, and resources are meant to be used. The only way to get out of a rat race is to have enough money working for you so that you don't have to work another day. The point isn't to lie on a couch and do nothing, but rather to have the freedom to do everything that you enjoy. So no matter how much you save, your money will run out at some point. That's why you should let your money work for you by buying assets. Remember, when we talked about assets versus liabilities, an asset could be anything from a rented property to a government bond. Investing in some ways is easy and straightforward. However, in practice, it's a little more complicated than it seems. Stocks don't always go up. Not every house is easily rented out. And government bonds can sometimes have a lower rate of return than inflation. So learning how to invest to get a high enough rate of return is an art by itself. Last but not the least, number 5. Keep your credit score high. You probably heard that you need money to take money. And that's true. Making a 5% return on $1,000 a year is just $50. Not even enough to get you a pair of sneakers from Nike. But a 5% on $100 million is $5 million. Enough money to let you live like a king in any corner of the world. Debt is an important financial tool. Whoever has mastered it has built a fortune out of nothing. And whoever is bad with debt ended up bankrupt. It's up to you on which side you want to be in. You can, of course, work and save every penny to buy a house 30 years later, or be good with debt and get a mortgage at favorable terms now. The first step to being financially responsible is keeping your credit score high. The easiest way to do that is through credit cards. I know that you might have a negative opinion about credit cards because you had to pay incredibly high interest since you didn't cover your credit card debt on time. That has happened to a lot of people. But if you are financially responsible, it's not that difficult to pay your debts on time to avoid the extra interest. Now you might say, why to use a credit card when you can use a debit card? Well, to build your credit score, you need to take credit and pay it back on time. You can basically use a credit card to pay for the things you pay with a debit card, and at the end of the month, simply pay your credit. That's how you raise your credit score, so next time when you need to get a mortgage, for example, banks will consider you a financially responsible citizen and would give you a better mortgage rate. Imagine how much you will save even by getting a slightly lower mortgage rate. Whether you like it or not, you have to learn to be financially literate to a certain degree because even if you hate money, you can't avoid it, and money will always play an important role in our lives. So start mastering at least the basic skills first. And there you have it. I hope you enjoyed this video. Make sure to give it a thumbs up, hit the subscribe button, and turn on the bell notification so don't miss any future videos. Thanks again for watching. Until next time, this is Wall Street.